So you've got $10,000 burning a hole in your pocket and you're wondering, how can I turn this into a massive pile of passive income? Well, my friend, you've come to the right place, because in this video, we'll be talking about 3 ways to invest your money right now to turn that $10,000 into a dividend generating machine. The first and most definitely the easiest way to put your money to work is by investing in exchange traded funds, or ETFs, which essentially are big baskets of stocks all packaged together in one fund, which makes it incredibly easy to start investing and start building that dividend snowball. The ETF approach is perfect for those who want to invest in a well-diversified portfolio but don't want the hassle of researching individual companies, which is perfect if you're looking for a more hands-off approach or just in the beginning stages of your investing journey and don't know where to start. I mean, I've been investing for a few years now and I've definitely learned a lot along the way as I've gotten more into it, but I don't really have a background with this stuff, and I most certainly didn't go to school to get a degree in finance. But in hindsight, considering how much I love investing now, that probably would have been a good thing for me. And on that note, I want to talk to you about today's video sponsor, Southern New Hampshire University. Now, as someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said I'd never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll learn to generate financial records and financial statements for users in accordance with governing rules and regulations. And you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on a call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryan or find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryan. Anyway, moving on and getting back to our ETF portfolio here. For our purposes, we're going to be investing in 2 different funds, SCHD and VU. Now, I've referred to SCHD before as the holy grail of dividend ETFs, and it contains over 100 different companies like AbbVie, Pepsi, UPS, Verizon, Coca-Cola, Pfizer, and Home Depot, who all have a history of consistently paying dividends. And overall, SCHD is a popular choice for those who are looking for a combination between dividend income and long-term potential growth. Now, VU here is a little bit different and essentially just tracks the S&P 500 index, which represents 500 of the largest companies here in the United States, like Apple, Microsoft, Amazon, Google, and Tesla. Now, taking a look at our sample portfolio here, we've got 50% divvied up into each of these funds, $5,000 into each one, and this portfolio would be yielding 2.62% with a 5-year dividend growth rate of about 11%, which is really high. Now, if we were to go back in time and invest $10,000 into this sample portfolio and then from there invest $100 every single month until today, we would have barely just beat the S&P 500 with a balance that's somewhat close to $58,000 compared to the S&P's just over $57,000, which I guess makes sense, guys, because 50% of our portfolio here is in the S&P 500, but we get a little bit of a boost from investing into SCHD. But really, guys, looking to the past is only going to get us so far. What we really want to know is, when can I retire and live off dividends with this portfolio? And to figure that out, we are going to be using the MarketBeat.com dividend calculator, and we're going to have a pretty similar setup here. An initial investment of $10,000 with $100 contributed every single month from there. And looking at the results, scrolling down all the way to the bottom, with this setup, guys, by the end of year 30, you'd be bringing in almost $28,000 of annual dividend income, and the portfolio balance on this would be just about $398,000. And you guys might be looking at that thinking, geez, only $400,000 after 30 years. That's not a whole lot, but remember, this is with only $100 every single month contributed to this portfolio. If you up those contributions, this portfolio value would be much larger. And even that aside, almost $30,000 of annual dividend income with just $100 a month is really not too bad. Now, moving on, if you're looking for something more exciting and want to test out your stock picking skills, option number 2 is just a portfolio of all individual stocks. And for our purposes here, we'll take a look at what I like like to call the perfect portfolio, which is something I created for another one of my recent videos. But this portfolio is comprised of 10 individual stocks in different sectors and industries, so it's pretty well diversified. And these companies have a history of paying consistent dividends and have generated market-beating returns. Think of this portfolio as the Avengers of the stock market, okay? Each stock brings a unique set of strengths that when combined make for an unstoppable team. And this approach to investing would be more fit for someone who thinks they'll enjoy researching companies and likes keeping track of the stock market, which in theory would be the opposite of the ETF investor. And taking a look at the breakdown of this portfolio, guys, like I said, we've got 10 different companies here, all in different sectors. And the dividend stats are somewhat similar to the ETF portfolio. Our yield here is a little bit higher at 2.75%, but the 5-year growth rate is about 1.5% lower at about 9.5%. And now taking a look at the back test for this portfolio, seeing how it stacked up against the S&P 500 across the last 10 years, this one absolutely blew the S&P out of the water, and you'd have a final balance of about almost $76,000, which is a lot higher than the S&P's $57,000. So you would have fared much better with this portfolio right here. And one important thing to keep in mind with this portfolio here is these stocks were all hand selected. If we would have chosen even just one different stock, the results here could have been drastically different. Like for example, if we were to switch out Apple with Intel right here, we would have lost quite a bit of money. We'd still be beating the S&P, but not by nearly as much. So one stock and one company can really make a big difference. And just like with the ETF portfolio, guys, we need to look into the future to see how much we would end up with if we invested into this portfolio across the next 30 years. And the results are kind of interesting. We would have ended up with about $14,500 of annual dividend income in year 30 by investing $100 every single month. And this is primarily due to greater share price appreciation from this portfolio right here. We have Apple in this portfolio, which absolutely crushed it in share price across the last 10 years. And this really shows if we take a look at the balance of this portfolio after those 30 years. $441,000, which is quite a bit higher than what we saw with that ETF portfolio. But anyway, moving on, last but not least, the third approach here is a hybrid approach between ETFs and individual stocks, which really gives you the best of both worlds. With this approach, you can try picking a few stocks and testing the waters there, and you also get the diversification that ETFs can provide, which I think act as a sort of safety net for your portfolio. And for our portfolio here, we're going to revert back to SCHD as the ETF base here. We'll put 70% into SCHD, and we'll choose 3 stocks with a 10% allocation into each one. And for the 3 individual companies, I wanted to make them ones that we might be familiar with. So I figure you could invest in something like your bank, you could invest in your grocery store. And then for the third one, maybe there's a company that you are a frequent customer of, like maybe you go to Starbucks every day and you get your latte and you get your egg bites. That would be a good one to invest in. And so with that said, for the 3 individual companies, we're going to go with Bank of America, Walmart, and Starbucks. And the stats on this portfolio are looking pretty good. This is the highest yield we've seen all day at 3.21%, and on average, it's got a 5-year CAGR of 11.4%. Interestingly enough, though, if we compare the backtest results across all 3 portfolios, we can see that this hybrid portfolio is actually right in line with both the S&P and our original ETF portfolio right here, all very similar, but still this one technically beating the S&P. But then looking 30 years down the road into the future, by the end of that 30th year, this hybrid portfolio would be generating $33,500 of annual dividend income, which makes sense because out of the 3 portfolios, this one had the highest yield, and it also had a pretty astronomically high 5-year growth rate. So you get a nice yield and nice dividend growth. And with that, you're also getting the highest portfolio balance out of the 3, coming in just under $450,000, which is nearly $10,000 higher than the individual portfolio and about $50,000 higher than the ETF portfolio. But still, guys, I mean, like we saw here, no matter which approach you take, it's still going to take you multiple decades to actually be able to retire and live off your dividend income. And if you're hearing that thinking, wow, that's a lot slower than I was expecting, 30 years is kind of a long time, then let me tell you, there is a quicker way to live off your dividends than what we've talked about here. And in this next video right over here, I'm showing you what that fastest way is, and also tell you why the fastest way might not actually be the best way. So click right over here to check that out, and I'll see you in the next one.